If you're married and retired, or planning to retire soon, there's one calculation most couples never run. What happens to the tax picture the year after one spouse passes away? Not emotionally, not legally, not socially, mathematically. Because while income often drops after the first death, the tax structure changes in ways many couples don't anticipate. And that structural shift can increase the surviving spouse's effective tax rate, sometimes significantly, even though household income declines. Today, I want to walk you through exactly how this works in 2026, calmly, clearly, without exaggeration. We'll look at what actually changes in the tax code, why it happens, and what planning opportunities exist while both spouses are still alive. This is not a special widow tax. It's not a penalty line on a tax return. It's a structural shift in filing status, bracket width, required distributions, and Medicare thresholds. And the earlier you understand it, the more options remain available. Let's begin with a simplified example. Imagine John and Linda, both age 68. They're retired. Their home is paid off. They've saved diligently. Here's their 2026 income picture while married filing jointly. $62,000 combined Social Security, $22,000 pension, $30,000 required minimum distribution from a traditional IRA, $8,000 in dividends and interest. That's $122,000 of gross income. After the standard deduction for a married couple over 65, their taxable income falls comfortably inside the 12% bracket. Their effective federal tax rate is modest. Medicare premiums are at standard levels. Nothing feels extreme. Now assume John passes away in early 2027. Linda's income changes. She keeps the larger Social Security benefit. The smaller one disappears. Pension survivor benefits drop to 50%. The IRA balance remains similar, and required minimum distributions continue. Her new income might look like this: $38,000 Social Security, $11,000 pension survivor benefit, $28,000 RMD, $8,000 investment income. Now her gross income is around $85,000. Notice something important. Her income dropped by nearly $40,000, but her tax exposure may not fall proportionally. Why? Because three structural shifts occur. Let's walk through them one by one. First, bracket compression. When married couples file jointly, tax brackets are significantly wider. In 2026, the 12% bracket for married filing jointly stretches to roughly double the width of the single bracket. When one spouse passes, the surviving spouse typically files as single beginning the following tax year, unless qualifying surviving spouse status applies under specific conditions. That means the same level of taxable income now fills up a narrower bracket ladder. Even though Linda's total income is lower, her taxable income may reach the 22% bracket faster than it did while married. This isn't a new tax. It's the same bracket structure, just applied to a single filer. Most couples never model this difference, and the impact becomes more noticeable when retirement accounts are involved, which brings us to the second shift. Second, required minimum distributions continue. Required minimum distributions, or RMDs, don't adjust based on emotional or financial hardship. They follow IRS life expectancy tables. If Linda inherits the IRA as a surviving spouse, she rolls it into her own IRA. The account remains tax-deferred, but RMDs still apply based on her age. Even if she doesn't need the income, the distribution is required. That distribution counts as ordinary income, And because she's now filing as single, those dollars are layered into narrower brackets. This is where the planning conversation becomes important. While both spouses are alive and filing jointly, bracket space is wider. Some couples strategically consider partial Roth conversions during those years to reduce future RMD pressure. The key is not reacting after the fact, but modeling ahead of time. Now, let's look at the third structural shift. Third, Medicare. IRMAA thresholds change. IRMAA, the income-related monthly adjustment amount, affects Medicare, Part B and Part D premiums when income exceeds certain levels. In 2026, married couples filing jointly have higher IRMAA thresholds than single filers. After a spouse passes, the surviving spouse is measured against the single thresholds beginning 2 years after the income year in question. Because IRMAA uses a 2-year look-back, income changes may affect premiums later. If RMDs, capital gains, or Roth conversions increase modified adjusted gross income, the surviving spouse can cross an IRMAA tier sooner than expected. It's not unusual for Medicare premiums to rise even though total household income declined compared to the married years. This catches many retirees off guard. And there's one more interaction worth understanding: Social Security taxation. Up to 85% of Social Security benefits can become taxable depending on provisional income. For single filers, the provisional income thresholds are lower than for married couples filing jointly. So, although Linda now receives only one Social Security check instead of 2, a larger portion of it may become taxable because of how the formula interacts with her RMD and other income. When you combine bracket compression, ongoing RMDs, and IRMAA adjustments, the surviving spouse's effective tax rate can increase, even if total income decreases. Again, this is not a penalty created specifically for widows. It is the structural outcome of moving from married filing jointly to single filing status while still holding tax-deferred retirement accounts. Now, let's talk about what can be done thoughtfully and strategically. Planning conversations are most effective while both spouses are alive. One strategy many advisors evaluate is phased Roth conversions during the years when married brackets are still available. Instead of converting large sums at once, couples may convert gradually, filling up lower tax brackets intentionally. This reduces future RMD balances and may provide the surviving spouse with more tax flexibility. Another planning consideration involves withdrawal sequencing. Some couples evaluate whether drawing slightly more from traditional IRAs during joint years at lower bracket rates makes sense compared to leaving larger balances for the surviving spouse. Pension elections also matter. Joint and survivor options provide continuity of income, though at a reduced monthly amount. Understanding the trade-off ahead of time helps avoid sudden income drops. Investment asset location can play a role as well. Holding some assets in taxable brokerage accounts where capital gains rates may apply provides different flexibility compared to relying solely on tax-deferred accounts. There is no single correct solution. The key is awareness and modeling. If you're married and over 60, it's worth asking one simple question. What does the tax picture look like for the surviving spouse? Not emotionally, mathematically. Run the projection. Look at taxable income as single. Evaluate RMD impact. Estimate Medicare premiums under single IRMAA tiers. See how Social Security taxation changes. Most couples never perform this analysis, and once the first spouse passes, planning flexibility narrows. That doesn't mean all options disappear, but certain strategies, particularly multi-year tax smoothing strategies, become more limited. The goal is not fear, it's clarity. Let me summarize the 3 core structural shifts: bracket compression, narrower tax brackets for single filers; RMD continuation, required withdrawals that maintain taxable income; IRMAA adjustment, lower Medicare income thresholds for singles; layer Social Security taxation on top, and the interaction becomes meaningful. Understanding these mechanics allows couples to evaluate whether small, proactive adjustments today might reduce complexity later. Before we close, here's a simple checklist you can review with your spouse. First, list all tax-deferred accounts and current balances. Second, estimate projected RMDs at age 73 and beyond. Third, compare current married bracket space to projected single bracket exposure. Fourth, review Medicare IRMAA tiers for married and single filers. Finally, consider whether a tax projection with a qualified advisor would provide clarity. Good planning isn't about reacting to headlines, it's about understanding structure. The tax code doesn't change emotionally after a spouse passes, but filing status does. And that structural shift changes how income is measured, taxed, and layered across brackets and Medicare thresholds. The earlier you review this, the more control you retain. If this breakdown was helpful, let me know in the comments what state you're in and whether you've ever run this calculation as a couple. And if you're married and approaching retirement, this is a conversation worth having sooner rather than later. Thoughtful preparation reduces uncertainty. I'll see you in the next one.